Welcome. In this video, we're going to break down the difference between nominal and periodic interest rates and show exactly how to calculate one from the other. Understanding how these rates interact is absolutely crucial for making smart decisions with loans, investments, and savings. First, let's define our terms. The nominal rate, also commonly known as the annual percentage rate or APR, is the stated interest rate for an entire year. This is the big bold number you see advertised by banks like 24% per year. On the other hand, the periodic rate is the actual interest rate applied to your balance during a single compounding period, like monthly, quarterly, or even daily. To find the periodic rate from the nominal rate, we simply take the nominal rate and divide it by the number of compounding periods per year. The number of compounding periods is just how many times a year the lender recalculates your interest and adds it to your balance. Let's break this down with a concrete example. Suppose we have a loan with a nominal annual interest rate of 24%. If the interest is compounded annually, the math is simple. 24% is applied once at the end of the year. If it's compounded semi-annually, we divide by 2. Your periodic rate is 12%, applied twice a year or every 6 months. If it's compounded quarterly, we divide by 4. Your periodic rate is 6%, applied 4 times a year or every 3 months. If it's compounded monthly, we divide by 12. Your periodic rate is 2%, applied 12 times a year or every month. And if it's compounded daily, we divide by 365. That gives us a daily periodic rate of approximately 0.0658%. Now, as a quick real-world tip, credit cards typically compound interest daily if you carry a balance past the due date. However, if you pay your statement balance in full and on time every single month, the lender won't charge you a single penny of interest. Now, let's see how this looks in action to understand why the periodic rate matters so much. Imagine you have a $10,000 balance at a 24% nominal rate, compounded monthly. As we just figured out, your monthly periodic rate is 2%. In month 1, 2% is applied to your $10,000 balance, earning $200 in interest. Your new balance is $10,200. In month 2, that 2% is applied to the new balance of $10,200, which gives you $204 in interest. This compounding effect keeps snowballing. By month 12, the interest is $248.67 for that month, leaving you with a final balance of future value of $12,682.42. In total, $2,682.42 in interest has accrued over the year. Notice how completely different that is from simply taking a flat 24% of $10,000, which would only be $2,400. That extra $282.42 is the direct result of monthly compounding. This example also highlights a fundamental rule of finance. The more frequent the compounding, the higher the actual effective interest rate will be. That is why looking past the advertised nominal rate and understanding the periodic rate is so vital when comparing loans, savings, or investments. And that's how interest rates work. Thanks for watching.